Yeah, so good evening all once again. This is Balram Uchidi. I'm the managing partner of Spectrum Auditing as well as SBC Tax Consulting UAE. I'm a chartered accountant from India. I have about 20 years of experience and we have been conducting the various webinars on corporate tax. So along with me, I have my colleague Abid, who is also a chartered accountant. So he'll be talking about the later portion. I'll be primarily covering about taxable income calculation and few other related information or concepts. And Abid will cover the participation exemption. So we in Dubai provide audit, accounting, taxation services, company formation, and value-added tax services. Under SBC banner, we provide corporate tax and transfer pricing services. We have a specialized team on transfer pricing who have been working for quite a long period in India, elsewhere. So they are now stationed based out in Dubai. And we also have presence in India, in Hyderabad, Bangalore, Chennai, Mumbai, as well as we have presence in USA. So we have been in practice in UAE for last years, servicing or providing services to various industries in UAE. So this is about us. Thank you all for joining us this afternoon. One important thing is that whatever we are covering here is only the personal views of the individuals who are talking here, and it no way should be considered as professional advice because the facts could vary, and based on that, the conclusion could vary. So we always advise you to refer to the original or the source, the original source, which is the Ministry of Finance or FTA. So the FTA's website has got all the literature that is required or relevant for corporate taxes. So we recommend you to refer to that literature before you take any decision. But our attempt is to just give you a little bit more understanding about the concepts so that you will be in a better position to understand the law. The only objective. So with this, I just would like to start the discussion. So primarily we'll be covering these two areas, as I mentioned, taxable income calculation as well as participation exemption. So under taxable income calculation, we'll be covering about exempted income, deductible and non-deductible expenses, gains or losses on realization basis. And we have certain transitional rules, so we will also cover those transitional rules. And then we will look at the calculation or tax return format, as well as the clarifications as per new FTA guide. Recently, like I think 3 days ago or 2 days ago, FTA has released one guidance on the taxable income calculation or computation. So recently, FTA has released a guidance on how to compute the tax income. So we'll try to cover some information from that also. And Abid will try to cover on participation exemption, like types of income covered under that, conditions of PE and participation exemption. Other important points to consider as well as practical application of the participation exemption, and then interaction with other tax provisions relating to this participation exemption. This is what we'll nutshell cover in this. And we request you to post your questions if you have any in the chat box. We'll try to address them at the end of the session. So, yeah. We'll get into the first topic, calculation of taxable income. Generally, the basis for computation of the taxable income is your accounting profit. So the profit and loss that you prepared as per the IFRS is what you have to look at, and then the profit or loss that you arrive to in that profit and loss account or income statement will be considered as a basis, and that amount will be adjusted in order to arrive to the taxable income. So you may have to less or deduct exempted incomes, or you may have to add back expenses that are not allowed to be deducted. So we'll look at this template again in detail in the later slides. But yeah, this is the basic thing that we wanted to cover. This is the summary of how it looks like. So your accounting profits, from that you will make some adjustments which are mentioned in the corporate tax law, whether to add back or to deduct. And then you will arrive to the taxable income. On that taxable income, you will have to compute the tax, which is going to be 0% up to 375,000 dirhams and 9% in excess of that. The tax rate is 0% for all the profits if you are a qualifying resident person. Otherwise, the general rates are like 0% tax up to 375,000 dirhams, 9% in excess of 375,000 dirhams profit or taxable income. So let's quickly look at the expenses which are incomes which are exempted. So you have all the incomes like your sales and your other income. Everything that you include is your total income. From that, you may have to see what are the incomes that are exempted, which are not subject to tax under corporate tax. So generally, the dividends that you receive or any other profit distributions that you receive from the investments that you make in the local juridical companies or persons. Within UAE, whatever investments you do as a company in another company, dividends that you receive from them and any other profit distribution that you receive from them is exempted. So that is not subject to tax as such. Not only that, dividends and other profit distribution that you receive from a foreign investment. You invested in a foreign company. You are a company in UAE and you invested in a foreign company. And the dividends you received or any other profit distribution that you received from that particular foreign investment is exempted if you are meeting the conditions of participating interest. So what is participating interest and all? Abid is going to cover that in detail. I will not touch base on that particular area. So dividends you receive from local entities or local investments is completely exempted. Dividends you receive from foreign investments or foreign investment companies is exempted as long as you are receiving it from a participating interest. And third thing is that any other income that you receive, which could be in the nature of a capital gain, a foreign exchange gain or loss, or impairment gain or loss from investments in companies, whether local companies in UAE or companies outside UAE. Any of these companies' investments that you make. So you may receive some capital gain out of the investment that you make in companies in UAE or companies outside UAE. As long as you're meeting this participation interest condition criteria, then that particular other income also is exempted. Your dividends are exempted, as well as your capital gains and other income also is exempted if you're meeting the participation. Income derived from by a non-resident person from operating aircraft or ships in international transportation. So there is a non-resident company which is operating or doing a business of operation of aircraft or ships in international transportation. So any income derived by that particular non-resident person is also exempted. Only condition is that this company, which is a non-resident company, wherever it is registered, that country also is offering the similar benefit to the companies from UAE, then only this benefit will be given to that non-resident person. So that is fourth thing. So fifth thing is that income of a foreign permanent establishment. So you have a branch outside UAE, and that is also generating income, and that is also subject to tax in that outside UAE country. Then generally, because it is a branch, it is also subject to tax in UAE. So it will be subject to tax in both the places in general. Of course, you need to look at the DTAs of between UAE and that country. But generally, the income that you generate out of this foreign permanent establishment would be subject to tax in outside UAE as well as in UAE. But in the UAE city law, they have given an option. You can elect to not to make this foreign permanent establishment as a taxable person in UAE. In which case, your income from that particular PE will not be subject to tax. At the same time, all the expenses and losses that you have for that particular PE will not be considered or clubbed for UAE corporate tax purpose. So all your incomes as well as expenses will be excluded or ignored for UAE corporate tax purpose. So this is an optional election that you have. If you want to elect for this, you can do so. So these are the income that you have which are exempted from UAE corporate tax law. So any other income other than these 5 categories of incomes will be subject to tax. So they could be subject to tax at 0%, or 0% and 9% accordingly. Now let's look at the deductible expenses. Any expenses that you incur with respect to your businesses are generally allowed to be deducted for corporate tax purpose. But there are some certain items which are specifically mentioned. Okay, So any expenditure that is incurred is deductible in the tax period in which it is incurred. Means if you're talking about 2024, all the expenses that you incur within this 2024. When we say incur, the expenses that you can recognize as expenditure according to IFRS. So those are the expenses which are considered as incurred. So any expenses you incur within this year can be considered as deductible expenses for this particular year when you compute corporate tax amount or income. So any expenditure that is incurred wholly and exclusively for business. So this is very, very important. Even in this recent guide also clearly mentioned that we need to look clearly whether the expenditure that you incurred, is it wholly and exclusively for business or not. If you have an expenditure which is incurred partly for business and partly for not for business, then you have to divide and arrive to the proportionate amount of expenditure related only for business. And only that proportionate amount of expenses can be allowed as deductible amount. And the rest of the amount will not be considered for corporate tax purpose. So this is important to look at. You have to look at all the elements of expenses and see whether they are wholly and exclusively incurred for business or not. And expenditure which is not related to business should not be claimed as expense for corporate tax purpose. In your books of accounts, you may still account that as your expenditure, but for computation of corporate tax and taxable income, you will have to look at only the expenses related to businesses and allow that as expense. Any expenditure that is not in a capital nature, so expenditure that is capital in nature will not be allowed as expenses to be deducted in the year. Of course, so if you capitalize this amount as an asset, you will be taking or computing depreciation. The depreciation can be claimed as expenditure or it can be allowed as expenditure under corporate tax. But the whole amount of capital expenditure will not be allowed as expenditure in that year in which you incur. You will capitalize this. On this, whatever depreciation that you compute for this particular year, that will be allowed as deductible expenses. Expenditure that is not related to exempted income. We have seen what is the exempted income in the previous slide. So any expenditure that you incur in connection to that particular exempted income is also not allowed to be deducted for corporate tax purpose. It is very obvious that you are not including the income for computation of tax. Accordingly, you are not expected to include the expenditure in relation to that particular income for computation of tax. So these are the 3-4 things that you need to clearly look at for any expenditure that you incur. Is it incurred in the current year or not? Is it incurred wholly and exclusively for the business purpose or not? Is it expenditure in the nature of capital or not? And is that expenditure incurred in connection to exempted income or not? These are the things that you need to look at to make sure that whether it is allowed to be deducted or not. There are certain expenses which are exclusively mentioned or are clearly mentioned in the law as non-deductible. So if you come across any of these expenses, you are not expected to deduct this for corporate tax purpose. As I mentioned, you may still take them as expenditure for books of accounts purpose, but for corporate tax purpose, you are not expected to consider them as expenses. Any expenditure that is there, which you have already debited in your P&L or income statement, when you compute taxable income for corporate tax purpose, you are expected to add. So what are those expenses? Donations, grants, or gifts. Any grants, donations, or gifts that are given to a qualifying public benefit entity, they are allowed to be deducted as expenses. But if you are doing this or contributing this to a organization which is not part of the qualifying public benefit entity, then they are not allowed to be deducted. So this is very important to look at. So the ministry has released the list of qualifying public entities. You need to make sure that whether the organization to which you're contributing, is it part of that list or not? If it is part of the list, then you can take this as expenditure and it can be allowed as deductible expenditure for corporate tax purpose. If it is not, you cannot take it as deductible expenditure. Second thing is that input value added tax. So which you claimed as input tax credit. So the VAT which we pay on expenses. If you are eligible to claim it as input tax credit and you already claim that as input tax credit, then that is not something that is allowed to be deducted for corporate tax purpose. Basic thing is that it is not your expenditure, hence you cannot claim this as deductible expenditure. Any bribes or illicit payments that you make, they are also not allowed to be deducted. It is very obvious. So we cannot claim that as expenditure. 50% of entertainment expenses. We will look at this in the later slides. We have a little bit more details in that particular thing. interest on related party loan without substance. So this also we have in the future slides. We'll talk about it in more details. Non-deductible penalties, fines. So any penalty or fines that you generally make for non-compliance of the law. So that is something that is not allowed to be deducted for corporate tax purpose. But if you are making any penalty payment as part of a contractual obligation, for example, you have a contract with your customer and you are unable to meet certain condition or term mentioned in the contract with your customer. So if you breach that particular term, there is a penalty. So if you're paying that penalty, so that is something that is paid as part of a commercial arrangement. That is allowed to be deducted. But if you have not complied with the law, for example, late registration penalty, corporate tax purpose. So this is something that is a penalty levied for non-compliance of the law. So that is not allowed to be deducted as expenditure for corporate tax purpose. So this is the difference that you have to look at it and then accordingly deduct or non-deduct. Any dividends or profit distribution from the company. Generally, the dividends and profit distributions that are made by the company are expected to be disbursed only after paying the tax. So your profits minus your tax, whatever is remaining, that amount will be considered for dividends and profit. So dividends or profit distribution is not an expenditure for corporate tax purpose. And net interest beyond your threshold or de minimis amount. This also will look into the future slides. We have detailed discussion on this. And the last point is tax on income outside the state. So tax paid on your income outside UAE or on your business outside UAE is not your expenditure to be deducted as deductible amount for corporate tax purpose. However, you may claim this as a foreign tax credit after completing the tax amount. This is not your expenditure as such. This is only a tax that you can claim as foreign tax credit if you paid any tax on your business outside UAE. So these are the expenses which are not allowed to be deducted from your income when you compute the corporate tax or taxable income. You may account this as expenditure in your books of accounts by following IFRS, but when you compute the taxable income for corporate tax purpose, you are expected to add these expenses back to arrive to the taxable income. So this is what I was referring to, entertainment expenses that are incurred for customers, shareholders, suppliers, and any business partners. Only 50% of that amount will be allowed as deduction. And the balance 50% is not allowed as deduction. As I mentioned, you may account this whole amount as expenditure in your books of accounts by following IFRS. But when you compute corporate tax or taxable income, then you have to add back 50% of this amount because that 50% is not allowed to be deducted. So what do you mean by entertainment expenses? So they have clearly mentioned that in the guide that any expenditure you incur towards meals, accommodation, transportation, or admission fees, or any other facility or equipment used in connection with the entertainment and amusement or recreation activities. So all these activities related expenses are considered as entertainment expenditure. So any of these category of expenses you incur for customers or shareholders or suppliers or business partners. So 50% only is allowed as deductible expenses and remaining 50% is not allowed. The next question is that what do you think about the expenses that you incurred for employees of the company? Entertainment expenses that are incurred for employees. They have clearly mentioned that generally it is assumed that this is incurred for business and as part of the business activity. So this can be allowed as expenditure fully for corporate tax purpose also. But however, if any of these shareholders or relatives of the shareholders or directors or any influential person is an employee of the company, that will be allowed as a deduction only if you make sure that that expenditure is at market rate. By following the benchmarking rules, you have to make sure that the payment to those connected persons is at market rate, though they are employees. Then only that whole amount will be allowed as deduction. If you are paying certain amount to those connected persons who are employees of the company, which is higher than market value, then that excess amount is not allowed to be deducted. That needs to be added back when you compute taxable income. This is very important to look at, and most of the people may not be aware of this particular thing. And next thing is about interest deduction rule. So whatever interest expenditure that you incur for business purpose is generally allowed as deduction. But however, they have given some de minimis threshold. only the amount that is falling within this particular threshold is allowed to be deducted, and excess of that will be only carried forward for the next years. And this carry forward of the interest is not adjusted, is allowed only for next 10 years. So when we look at the interest expenditure, so it is net interest expenditure is what we are looking at. When I say net interest expenditure, your interest expense minus your interest income. So this net amount is considered as net interest expenditure deductible. So now we need to see whether this amount is excess of this threshold given or not. If your net interest amount is 12 million or less than the 12 million dirhams, it is still fine. That total amount is allowed as deduction. But if that amount is exceeding 12 million dirhams yearly, in that case, you have to see whether that amount is exceeding 30% of your EBITDA or not, earnings before interest, tax, depreciation, and amortization or not. So you have to arrive to this EBITDA and compute 30% of that. Then see whether this interest amount is exceeding this 30% of EBITDA or not. If it is exceeding, then that excess amount is not allowed to be deducted, and that excess amount can be carried over to the next years, and then you can adjust against next year profits. So with respect to this EBITDA, in the recent guide, they've clearly mentioned that the EBITDA, when you compute, how do you have to do is that you first have to arrive to the taxable income by making all the adjustments that are mentioned in the corporate tax law from your accounting profit. And to that taxable income, you add back this interest, depreciation, amortization. That is the amount that you have to consider as EBITDA. And for that, you compute 30%, and the 30% amount will be your threshold to compare your net interest expenditure deductible amount. As I mentioned, if it is exceeding 30%, that excess amount cannot be allowed as deduction in this current year. However, you can carry forward for the future years. So these are the items that I mentioned clearly as to which all will be considered as interest and interest. One important thing is that the finance cost related or finance lease related interest also will be considered as interest for this particular purpose. Not only this, capitalized interest, whatever you have, borrowing costs or whatever, that also will be considered for this deductible expenditure on the top of corporate taxes. So there is an option given for the companies to see or to make your gains or losses on sale of gains, primarily gains or losses on sale of your assets, whether you want to consider them on realization basis or on non-realization basis. Whenever you sell any particular property, for example, you may have gain or losses. Or if you are going for any revaluation, so that revaluation gain also is something that you may have to consider for your books of accounts. So you may include that as an income in your books of accounts. But that gain on revaluation is something that is not realized. If you have not chosen this realization option, then whatever gain that you arrive to on revaluation, that will be subject to tax in the year in which you revalue. So in this case, what is happening is that you have accounted that gain, but however, you have not realized that gain. The gain will be realized only when you sell it, when you sell that particular asset. Until then, this is only a book entry. So if someone is following the cash basis of accounting, you will consider the gain or losses only on realization basis. So there is no option given to you. So this option is available only for the companies which are having 3 million turnover or less. For any other company which is having turnover more than 3 million dirhams, for them there is no option, but they have to follow accrual basis of accounting. So in which case you have an option whether you want to consider these gains to be subject to tax on realization basis or on unrealization basis. Okay, and this option is not available for all your assets and liabilities. There are only two options that are available. For all the assets and liabilities, option one, for all the assets and liabilities that are subject to fair value or impairment. Only that particular class of assets or category of assets which are subject to fair value or impairment. Examples are like land, buildings, machinery and equipment, investment property which are carried at cost, intangible assets, goodwill, investments in subsidiaries, associates and JVs. So all these assets which are generally subject to fair value or impairment, they are eligible to be falling under this particular option one. If you have these assets, then you can select whether you want to go for unrealized basis or realized basis to be subject to tax. And this option you have to select or elect only in your first tax returns. If you forget or ignore to select this option for in your first tax returns for any of your assets, it will be by default will be considered as unrealized basis of option, and then you will be subject to tax as and when you have gain or loss within the period. Okay, before without waiting for the realized date. So that is about option one that we have. Option two is assets and liabilities which are on capital account. So assets held or capital accounts are refers to assets that the person does not trade, assets that are eligible for depreciation, or assets treated under applicable accounting standards as property, plant and equipment, investment property, intangible assets, or other non-current assets. So all these assets are considered as assets held on capital account, and this class of assets will fall under option two. Liabilities which are held on capital account refers to liabilities, the intangible incurring which does not give rise to deductible expenditure and which are non-current in nature. So these liabilities are also something that you can consider. So we have certain transitional provisions which you need to consider at the time of computing your taxable income, and especially these are relevant for the first tax period. And there are certain conditions for those assets and liabilities. They have given this option only for qualifying immovable properties, financial assets and liabilities, and intangible assets. Only for this particular category of assets, you can select this transitional provision. And there are certain conditions to be met, like you have to own these assets before your first tax period, and those assets should be measured in your financial assets at historical cost only. If you are following any fair value method for that particular category of assets, then this particular option is not available. And these assets are liability. These assets are disposed or deemed to be disposed only during your first tax period for a value exceeding net book value or later. Okay, so there are three conditions that you need to look at. These three conditions are applicable to be looked at for your immovable properties or intangible assets, and only first two conditions are to be looked at for your financial assets and liabilities. Now, what does it mean? So what are you getting the benefit out of this particular transitional rule? Generally, you own a particular asset before the tax regime is applicable to you, and then you are selling this asset after the tax regime is applicable to you. Okay, so you may make some gain out of this particular sale. So this entire gain that you arrived is not necessarily be connected to the period that is falling within CT regime. You may have to apportion certain amount of the gain for the period relating to the before CT regime, because you own this particular property before CT was applicable to you. So you have certain period asset owned by you before CT regime, and you have the asset held after CT regime also. So the gain that you arrive is generally is expected to be apportioned for these two periods, and you have to, or you're expected to make the gain which is relevant for your CT regime period as taxable gain, and the rest cannot be or should not be allowed as or is not subject to tax. So that is the whole idea. What is that? What to adjust from the total gain is exclude the amount of gain that would have arisen at the start of the first tax period had the qualifying immovable property or any property that is mentioned there being disposed of at the market value, and the cost of qualifying more property was the higher of original cost and net book value. So if you were to sell the property on the first day of your tax period, first tax period, what would be the gain? So that gain is what they want to remove from your total gain. Okay, this is the concept in nutshell. We'll look at an example to understand it a little bit more. So they have given two options. One is as to how to compute the deductible amount or exempted amount of the gain. So they have given option one, which is market value method, option two, which is time apportionment method. And market value method is you are looking at the value and then arriving to the exempted amount of gain. You have to compute what is the market value as on the start of the first tax period, and then cost of the property. The cost is generally considered as original cost or net book value on the first date of your first tax period, whichever is higher. Okay, so that becomes your cost. Market value on day one and cost on day one. So market value minus cost value will give you the gain, which will be exempted. So from total gain, this exempted gain will be removed and the net amount will be subject to tax. We'll look at an example again to understand this. Option B is time opposing method. So here you're looking at the time period that you hold the property. First, you'll arrive to the sales, the gain on sales, which is nothing but sale value of the property. Whatever sale proceeds you receive from the sale of the property, that minus cost. Cost is again the same, higher of the original cost and net book value as on first date of your first tax period, higher of this. So your sale proceeds minus cost as computed. You will arrive to the total gain on sale. So this gain we will consider as an amount. And now you have to arrive to the number of days. So what are the two number of days that we have to look at? Number of days that the asset is owned before start of the first tax period, and the total number of days that you own that particular property. Okay, so total period, and you also arrive to the period that you own the particular property before tax regime was applicable to you. So this is what you have to arrive to. And then once we have these 2 days, then you compute the exempted amount of gain, which is nothing but your total gain multiplied by the number of days that you owned the property before CT regime was applicable, divided by total number of days. So that will give you the gain that is to be exempted. So total gain minus this exempted gain will be the net taxable gain. So we will look at one example to understand this particular option. I'll come back to this slide later. So let's say that you own a property and you bought it on 31st January 2022. And the cost of the property was 1 million dirham. And on 31st December 2023, the net book value is 1 million dirhams. Ideally, it's not right, but just for ease of understanding, we kept it for 1 million. And then market value of the particular property is 1.5 million dirhams. And for your company, the property tax is applicable from 1st January 2024. So these rates, these amounts are the amounts that are available as on first day of your first tax period. And this particular property is sold on 31st December 2026 for 2 million dirhams. So these are the facts of the scenario. Now let's compute what will be the amount of gain that is exempted under option A and option B. So this is option A and option B. So as I mentioned in option A, you will look at the if you go back to this option A here, the market value as on start of the first day minus cost as on the first day. So here, as I mentioned, the market value as on the first day of your first tax return is 1.5 million. And then cost value is generally arrived to be at net book value on first day or the original cost on, of your purchase of the property, whichever is higher. Here, both the cases are 1 million dirhams. So 1 million becomes your cost. And market value as on first day of your first tax return is 1.5 million. So your gain is a gain which is exempted is 1.5 million, which is market value, minus 1 million, which is cost, which is given nothing but 500,000. So your total gain on sale was 2 million minus 1 million, which is 1 million dirhams. From that, exempted amount is 500,000. So net amount of gain which is subject to tax is the balance 500,000. Okay, if you go for option 1, if you go for, which is market value basis method. If you go for option 2, which is based on the number of days that you hold versus number of days that you hold before corporate tax regime was applicable to you. So if you see the total number of days that you own the property from 31st January 2022 to 31st December 2022, total days that you held was 1,825 days. And the number of days that you held the property before CT regime was applicable, which is from 31st January 2022 to 31st December 2023. So that is going to be 730 days. Now you have to take the total gain, that is the gain of the difference between your market value as well as this. So total gain is 1 million dirhams. Out of this, you have to compute what is the gain that is removed or allowed as exemption, which is nothing but total gain divided by total number of days multiplied by 730 days, which is number of days that you had before tax regime was applicable to you. So 1 million divided by 1,825 into 730. That gives you the amount of gain that is exempted. So if you compute this, you will arrive to 400,000. So out of your total 1 million dirhams or total gain, 400,000 is exempted gain. Then balance 600,000 will be subject to tax if you opt for option B. Okay, so this is how you compute, and accordingly you decide which option you want to go for. So these are the details of option 1 and option A and option B. Now this option A and option B are not available for all the properties. Both options are available for your qualifying immovable properties. And for qualifying intangible assets, only option B is available, which is time apportionment method. And for qualifying financial assets and liabilities, only option A is available, which is fair value or market value method. So these are the transitional provisions that we have, and this is the computation that we generally do. Let's quickly run through the template that we have for the computation of your taxable income and then tax amount. So as I mentioned, you take the accounting income or profit as a basis. Whatever profit you arrive to in your profit and loss account or income statement, that will be considered as the basis for computation of taxable income and tax liability. So let's say you have a 90 million dirhams as your profit in your books of accounts, which includes 20 million dirhams as a profit which you arrived on sales made in Saudi. Okay. And whatever exempted income that you have, if you have any exempted income which is considered in your profit and loss account, and that you generally will be removing because this is already included in your profit. Now you will have to remove because it is exempted from corporate tax purpose. Here in this case, we do not have any exempted income, so no deduction to be done. And now we have to add back the expenses which are not allowed to be deducted for corporate tax purpose. These expenses you must have already shown as expenditure in your profit and loss account. Now we have to adjust those expenses so that we arrive to the taxable income. When I say taxable income, profit minus plus or minus your corporate tax related rules, related numbers, and then you arrive to the total net profit or net taxable profit, which is generally called as taxable income. So if you have any donations, grants, or gifts that you've contributed to an entity which is not qualifying entity for this purpose, then that donation or gift needs to be added back. So 1,500 is what we are adding back. If you have any fines and penalties which are paid for non-compliance of the law, that will be added back. Here we do not have any. If you paid any bribes or illicit payments, that also will have to be added back if you have already debited your P&L account. If you have any dividends or profit distribution that are made, obviously these are not their expenses, so these need to be added back if you have debited. Generally, it should not be. And any provision for corporate tax that you made in your books of accounts, if you already provided, let's say that out of 90 million, you already computed and made some provision towards the corporate tax purpose. So then 8 million dirhams is what you have to add back if you've already debited as a provision to your P&L account. And recoverable input VAT, not claimed as input tax credit. Obviously, it is something that you're eligible to claim as input tax credit, but you have not claimed. It becomes your expenditure in your books of accounts. But for corporate tax purpose, it is not allowed as a deductible expenditure. So you have to add this back. And tax on income imposed on the taxable person outside UAE. This 20 million dirhams, whatever you paid, or whatever you included in your profit, let's say 20% is a tax to be paid on the profit. So you paid 4 million dirhams outside UAE that you've shown as expenditure in your P&L already. Now we are adding this back. So all this together comes to 12 million dirhams, which we are adding back to your profit, books profit. And at the same time, you have to make some certain adjustments, like, if you have any gain on intra-group transfers, which is generally not allowed, or if it is not at arm's length, and if you are expected to add this back, you'll be adding this back. And if you have selected any unrealized losses, you have selected, as we discussed in the transitional provisions, if you have selected or elected realized relation basis or method of this thing. So any losses that you have on your profit, on your assets or liabilities, since it is not realized, so you have to deduct it if you already debited your P&L account. So after making all these adjustments, you are arriving to your taxable income, which is 100 million to be specific, 101,800,018 dirhams. So this is what is your taxable income. On this, we have to compute the tax. So as I mentioned, up to 375,000 dirhams, tax is 0%. Taxable income in excess of that particular 375,000 dirhams is 9%. So 101 million minus 375,000 dirhams. On that, if you compute 9%, it comes to 9 million, 9,129,398. So this is what is your tax payable amount. But since we have paid some foreign tax in 20 million dirhams profit, not the entire amount of your tax that you paid, just 4 million dirhams will be allowed as foreign tax credit. It is only the 9% on the effective amount of profits will be considered as foreign tax credit. So out of 20 million dirhams, if you compute here, since we have only 9% as tax, 20 million minus whatever amount you have to deduct, and then 9% tax on this comes to 1.8 million dirhams. Though you paid 4 million dirhams as tax in Saudi on your profit of 20 million dirhams, you will get foreign tax credit only to the amount of 1.8 million dirhams. So this is what you have to be careful about. Earlier, this total amount of 4 million was your expenditure, but now you are able to claim 1.8 million out of 4 million as foreign tax credit, and 2.2 million becomes your cost. And then after adjusting all this amount, whatever amount net, 7 million dirhams, 7.3 million dirhams is your balance tax payable. So this is how we generally compute the tax. You take your accounting profit as basis, plus or minus whatever you have to adjust according to the corporate tax law, and the net amount is taxable income. On that you compute taxes and then adjust whatever foreign tax credit that you have or any other reliefs that you have, like business relief, restructuring relief, or tax losses. If you have any carry forward losses or losses that you received from other entities, all those will be adjusted against your tax payable amount. Then the net amount becomes your balance tax to be paid. Let's quickly look at some of the important points that were discussed in the recent guide on your computation of taxable income. They clearly mentioned that you have to look at this expenditure, whether the concept of wholly and exclusively incurred for corporate tax for businesses or not. As I mentioned, any expenditure that you incur, you need to make sure that that is wholly and exclusively incurred for business purpose. So this will be looked at carefully, and you have to make sure that all the expenses that you have in your books of accounts, which you will consider for corporate tax purposes, are meeting this particular criteria of wholly and exclusively incurred for business purpose. As I mentioned, if any expenditure which is incurred partly for business and partly not for business, so that proportionate amount of expenditure relating to business wholly and exclusively for business only will be allowed as deductible expenditure, and the rest of the amount will not be allowed as deductible expenditure. So this you need to be clearly looking at each element of expenses and see if there's any partly incurred expenditure, then accordingly compute based on a right basis. You have to look at the relevant basis to apportion these expenses. So that also they discussed in detail in the guide. So you can go through the guide. They have given some examples also to look at, and then those examples may be relevant for you. And the specific interest deduction limitation rule, this applies when loans are used for tax arbitrage activities. If you're trying to take any loan from any of your related parties, and those loans are used for paying the dividends or paying the repaying this share capital amount, then that is something clearly is assumed or understood as something that you're paying or doing to reduce the tax. If that is the case, then the interest paid on this particular loans is not allowed as deduction. So they have given more emphasis on that particular clause also. They have given some examples in relation to this as well. So any expenditure that you incur or interest you incur on this particular loan will not be allowed as deduction. As I mentioned, the EBITDA used in general interest deduction limitation is not just the accounting EBITDA, but it is the tax EBITDA. Means you have to compute the taxable income by making adjustment to your accounting profit, and then to that particular taxable income, you make adjustments of this interest, tax, depreciation, and amortization. That becomes your EBITDA to consider for your general tax deduction limit. And the order of deduction also was mentioned in the guide. The tax losses are utilized before interest deduction limitation. So first you have to adjust your carried forward losses or losses you received from other entities. and then the net amount will be considered for your interest and deduction computation. And then the other point is that while tax loss transfers are considered, this 50% ownership plus the change of the business activity. So whenever you are carry forwarding a losses, so you need to make sure that the ownership is there at least minimum 50% common, and the business activities of the company are also same in the year in which the tax losses are incurred, as well as in the year in which you are offsetting the tax losses, carry forward tax losses. So they should be same. So your ownership should not be more than changed more than 50% in these 2 years. Or if you change the ownership of more than 50%, at least you need to make sure that the business activity of the company in both these years is more or less same. If you have changed the ownership more than 50%, as well as your activity is also changed significantly, then whatever tax losses you incurred in the year one will not be allowed as tax losses to be offset in the year when you are trying to offset. So that point also was clearly discussed in the law, in the guide. And businesses with annual turnover exceeding 3 million dirhams, if you are following cash basis, if your turnover is exceeding in the year more than 3 million dirhams, then you are expected to follow the accrual method in the following year. So this also is mentioned. There are a few points that are mentioned in the guide. There are other points also which are very, very important to look at. You may go through that guide, and the guide is very useful for computing the tax law, taxable income. So I've taken a little bit more time, but yeah, I'm sure the time that you will be spending for participation exemption, which Abid is going to take over, will be useful. I request you to just bear with us with respect to the time. So Abid, if you are there, I hand it over to you to consider cover the participation exemption.
Sure, sure. Thank you so much, sir. It was a wonderful presentation, and in turn, it was very insightful, and we really appreciate that. I'll just share my screen. So hello everyone, I am Abid Muhammad. I'll be deeping dive into the intricacies of participation exemption. So let us first understand what is participation exemption. But before that, let's see where all the participation exemption have been referred in the law and the various guides as on. So there is an article 23 in the corporate tax law which specifically talks about the participation exemption, and with that article we also have a ministerial decision 116 of 2023 which specifically talks everything about the participation exemption. And apart from these two, we also have a corporate tax guide on exempt income, which is dividends and participation exemption. Apart from these three, there are few other references as well of the participation exemption, which are herewith mentioned below. So moving to what exactly is the participation exemption. So now let us first understand what a participating interest means and what exactly is going to be covered under the participation exemption. So here now on the screen, as you can see here, entity A has interest in entity B. Now, this interest may be in the form of ownership of the shares of entity B. That means entity A owns ownership or has any ownership in entity B. So this is the interest. Now, whether this interest will be a participating interest or no will be depending on the conditions. But now let us first understand what all can be an income of entity A in turn in consideration of the interest. So now, because entity A owns shares in entity B, it may have dividends because entity B can declare dividends. So entity A will obviously get dividend income. And it can also, entity A can also sell the shares or transfer the shares in entity B to any other entity. And it can also have forex gains or losses. It can also have the impairment gains or losses of the shares amount that entity A is having in its balance sheet. Now, apart from all these four, the entity A can also incur some expenditure relating to the interest in entity B. So now this related expenditure can be also deductible or non-deductible based on whether the conditions are satisfied or not. But this related expenses, when I talk specifically about the related expenses, one thing has to make sure that I am only talking about the operational or the expenses which are incurred once the entity B is acquired or the interest is acquired. Any expenses relating to the acquisition of entity B will be capitalized in the books of entity A, because it is relating to the interest in the entity B. So I'm not talking about the acquisition related expenses. I'm only talking about the operational related expenses in entity B. So now all these five kind of income as well as expenses, there are two things here now. Now these two things will be let's say if the participation conditions which we are going to discuss in the later slide, if the conditions are satisfied, then the income relating to income relating to this interest is not a taxable income. On the other side, we also have to take in mind that any expenses relating to this participating interest will also be not allowed as deduction while calculating the taxable income. One more thing which has to be taken a note of is this participation exemption is an automatic election, unlike small business relief. So in the small business relief, if you want to elect for a small business relief, you have to actually elect in your tax return. But for the participation exemption, for you to be exempted, there's no election. It is automatically applied, and you'll be getting the exemption on the income, and the expenses relating to that will not be allowed as deduction. So now let us just deep dive into what are the conditions of participation exemption. Now, majorly we'll be covering the five conditions. There are majorly five conditions of a participation for an entity to be considered as a participating interest. So now let us first dig into what is a minimum ownership interest test. So this talks about the 5% of ownership in the participating interest. In the example which we saw here, entity A was having an interest in entity B. Now, this interest should be in the form of ownership. That is the first condition. And that ownership should be at least minimum of 5% ownership. If it is not 5% of ownership, at least it should be the cost of that ownership, which entity A has acquired, should cross AED 4 million. This is the first condition. Now, one thing which is important to understand in this condition is that entity A should be an economic owner of the entity B. It should not only on the legal owner, it should be actually an economic owner who is benefiting from the interest in entity B. Now, in this, when I talk about the 5% rule, when I talk about the 84 million rule, I say that this 5% is not only when entity A should have, it should be entity A plus its qualifying group members also. So now let's say in a qualifying group, entity A with any other entity in the qualifying group having more than 5% ownership of entity B, then this condition is said to be satisfied. So this is an aggregate of all the, I would say, the shareholding percentage of all the entities within a qualifying group. Now, when I talk about the 5% or AED 4 million, we also have to make sure that this 5% of ownership includes equity ownership and preference ownership or any other kind of equitable instruments in entity B that entity A is owning. That means if I own 3% of equity shares and 2% of preference shares in entity B, then I am set to meet the conditions. I am set to meet the condition number 1 here. So this is condition number 1, which says that minimum ownership should be 5% or 84 million. Now, if we move on to the second condition talks about the holding period test. Now, holding period test is basically says that A is having ownership of B, let's say more than 5% or 84 million, but that ownership interest should be actually held for more than 12 months. So 12 months, when I say it can be either actually 12 months or it should be intended to be held for more than 12 months, because we may face a situations where 12 months is not over, but the compliance is there. So there, that point of time, the actual intention, whether the intention of a taxable person is to hold that for 12 months or no, is to be checked. If the intention is there to hold for more than 12 months, then this condition is said to be satisfied. We also have to make sure to understand that this holding period test of 12 months is to be considered. Let's say if I have a company which in company with another qualifying group member, if I transfer to another qualifying group member, then that qualifying group will also consider this 12 months into consideration. That means either me or my qualifying group member should at least hold it for 12 months to get this condition as satisfied. This is important. Now, there may be situations where exchange of shares comes into picture. Now, when I take into ownership of another entity by way of purchasing their shares, and then I allot my shares to them, so this exchange of shares is also considered as a participating interest in terms of this condition 2. When I move ahead to condition 3, which is subject to tax test, here the law says that the entity B, I mean in the entity in which I'm having the ownership interest, should actually pay in tax at more than or equals to 9%. 9% is the basic tax rate in the UAE, the corporate tax rate. So this tax rate should be applicable to that entity also in which I have a participating interest. Need not be actually the 9%. It can be more than 9% also. Need not be that entity be in UAE also. It can be outside UAE. Let's say if it is in India. In India, we have 25%, 22% tax rates for corporates. So that will also be considered as meeting the condition. Now, when I talk about subject to tax test, there may be situations where, let's say, the entity applicable tax rate is more than 9%, but the effective tax rate is 0%. Sometimes it happens, like in India, if you talk about SEZ units, SEZ entities, they pay tax rate at the rate of 0% for the 10 years. So that point of time, whether we have to take the actually applicable tax rate or we have to take the effective tax rate. Understanding this is also important in this condition. So this condition says, the law says that it should either meet the 9% applicability test or 9% effective tax rate test. That means even if an entity is not actually paying 9% tax, but the applicable tax rate is 9%, then this condition is said to be satisfied. On the other hand, if the applicable tax rate is more than 9%, but it is not paying any tax due to any deductions, reliefs, or exemptions, and effective tax rate comes below 9%, even then this condition is said to be satisfied because the entity is actually applicable to pay tax at the rate of 9% or more. This is important to understand here. Apart from this, there is also a holding company exemption. So when I talk about this subject to tax test, this condition is not applicable to any entity which is actually a holding entity or an investment entity. So when I talk about an investment entity, it should actually get the gains from the investment, and the main principal activity of that holding company should be to invest and gain from the investments. So subject to tax test has to be met. One thing is to be kept into mind that all these conditions are required to be satisfied to consider it as a participating interest. Even if one condition is not satisfied, then it is not said to be a participating interest, and therefore all those income which we saw, dividends and any other profit distribution, let it be sale, transfer, or disposal of the interest, all those income will be taxable in the hands of A in our example. Now moving on to the fourth condition, which says that entitlement to 5% profits and 5% liquidations proceeds. Now this actually talks about the objective of this condition, I would say, is to prevent any entity by having only the ownership and not be actually the economic owner. Okay, not only be economic owner in the sense, let's say if that entity only owns but it is not entitled to get the profits. So to prevent this kind of situations in the future, the law has said that you have to meet the 5% ownership as well as the 5% profits as well as the 5% of liquidation proceeds. So when we talk about this 5% profits, that means any profits which are distributed by the participating interest, entity A or the taxable person, in our example entity A, that taxable person should be entitled to get more than 5% profits from the participating interest. If this condition is not satisfied, then obviously all these conditions are said to be irrelevant, and then the participating interest is said to be taxable. The second thing in this is, it basically this condition is to ensure that there is a substantial interest, there is actually an interest in the participating interest. It's not only on the paper, it's actually an interest, to prove this condition to be satisfied. Now moving ahead to the condition assets test. This assets test is actually a bit complicated, so I've created two examples which we'll see in the ensuing slides as well. This condition says that 50% of the assets of the participating interest should not be those assets which are not exempted from the corporate tax. So now to understand this, we have two examples in the coming slides. So I'll just walk through these examples to understand this better, because this assets test is actually very important to understand for these entities, which I'm going to discuss in the ensuing slides. So in the example which you are seeing in the front of your screen, UAE Holdco, there's a UAE company which is holding entity, let's say India Holdco Limited, which is paying tax at the rate of 25%. Now, UAE entity is said to be a taxable person here in this case. Indian entity is, let's say Indian entity is also Holdco, that means it is also an investment company. So it has to have investments into other entities in India. So now the purpose of India Holdco is to hold investments of entity A, B, C, which are an operating entities here. Now entity A and entity B and entity C, these three are actually the operating entities in India. But if you see here, entity A, the ownership in entity A is only 4%. Only 4% is owned by India Holdco in entity A, and 10% in entity B, and 20% in entity C. Now, in this case, if you see, the tax payable by the India Holdco is 25%, which is more than 9%. The condition is said to be satisfied. But here, if you see the 4% in entity A, even though entity A is paying tax, but only 4% means that this condition of 5% is not satisfied. That means any interest from any income or expenses in relating to A would not be a participating interest. Now, if you see about the entity B, India Holdco owns 10% in entity B, but the tax payable by the B, the applicable tax rate is 0%. So again, entity A and entity B, both of them have not satisfied the conditions of a participating interest. Obviously here, because an Indian holdco is there in between, the participation exemption has only to be checked from the UAE holdco perspective. But let us just understand this example by way of this arrangement where C, under which the ownership interest of India holdco is 20%, and the tax applicable to C is also 25%. So that means C is actually considered as a participating interest if it would have been directly held by UAE Holdco. So in this example, as you can see, A and B is not satisfying the conditions, all the conditions which we saw in the previous slide, but only C is satisfying the conditions. Now, assuming that the cost of all these entities, cost of owning the 4% or 10% or 20% in these entities are equal, there is only 1/3 of the assets. That means only C, okay, 1/3 of the assets of India Holdco, which has satisfied the conditions of a participation exemption. Then, because it is only 1/3, which is about 33.3%, only 33.3% has been satisfied. Then in that case, any dividends or any kind of income, which we have seen in the previous slides, any kind of income from India Holdco to the UAE Holdco will also not be said to be satisfied as a participating interest. Therefore, these all dividends on these all, whatever the kind of income you say, this all will be considered as a taxable income or deductible expenditure in the books of UAE Holdco. Now, this example is to understand the assets test. Now let's also talk about the second example. Now, in this example, the facts and everything remain same, only a slight change that, let's say, India Holdco holds 100% in entity A, B, and C, all of them. That means here the conditions of participation exemption has been satisfied by entity A and entity C, but not entity B, because entity B is actually paying tax at the rate of 0%. So it is not more than 5%. So this condition is not satisfied by the entity B. So now here, the balance sheet of India Holdco, if you see, considering it as equal ownership and equal investments in all of them, if we see the balance sheet of India Holdco Limited, we see that two-thirds of the assets, because India Holdco is holding the investment, so it is an asset. So two-thirds of the India Holdco's assets are actually satisfying the conditions of a participation exemption. So in this case, because it is crossing 50%, then in that case, any interest or any dividend or any profit distribution from India Holdco to UAE Holdco will not be considered as a taxable income. That means here the participation exemption conditions are met. All the participation exemption conditions are met in this case, unlike the previous example. So by this, we have understood about the assets test, because this is actually an anti-abuse rule. This is to avoid any entities having an arrangement in such a way that non-qualifying entities are supported with an intermediary qualifying entity and then shifting the profits. So this is how the assets test is read. Now, if we talk about whatever we have read till now, just to summarize all those points, now entity A in that example which I saw, entity A and entity B, let's say entity A is having ownership in entity B, whether this ownership is considered as a participating interest or no has to be checked from this flowchart. So now let us go through this flowchart. So first, now let's understand whether entity B is actually having ownership of entity B or no. Entity A, whether it is having actual ownership of entity B or no. If it is yes, then we have to see the other condition. If it is no, then it is straight away not a participating interest. Now, when we say about ownership, ownership should be more than 5%, or it should be the cost of that ownership should be at least 4 million. If this condition is satisfied, then we check the other conditions. If this condition is not satisfied, again, then it is not a participating interest because the condition is not satisfied. If this condition is satisfied, then we go ahead and see that whether this ownership of entity B in the books of entity A is held for 12 months or no. If this is not held for 12 months, then we have to see actually the intention is whether it is to hold for 12 months or no. If it is yes, if they have held for the more than 12 months, then the other conditions has to be checked. But but where they have not satisfied this condition, again it is said to have not a participating interest. Once this 12 months condition is checked, then you will see whether the entity B is paying tax at the rate of 9% or no, or the effective tax rate is more than 9% or no, or the applicable tax rate is more than 9% or no. If this condition is not satisfied, then we have to see whether the primary activity is holding or no. If the holding company condition is satisfied, then the other conditions we have to see. But if this condition is not satisfied, then we have to see whether it is a qualifying free zone person or no. If it is not a qualifying free zone person, then and it is not also a holding company and it is not paying tax at the rate of 9% also, then it is not a participating interest. Now, moving ahead, if we talk about the 5% profits and 5% liquidation proceeds test, that also has to be satisfied. And that you can see once if it is not a QFZP or if it is a QFZP, then you have to see whether this condition is satisfied or no. And if this condition is satisfied, at the last, you will see the assets test, which we just saw by 2 examples. So that assets test also has to be satisfied. Once if that is satisfied, then all the conditions are said to be satisfied. And once all the conditions are said to be satisfied, this entity B will be considered as a participating interest, and then any income from entity B to entity A will be not considered for taxable income purposes. Now, we saw what all incomes are covered and what all incomes, what all types of incomes are covered here and what are the conditions. But now let us dig into what all are not covered in the participation exemption. Now, if we talk about any interest, any income in a non-participating interest, then that point is not covered here in the participation exemption. Also, any transactions within the tax group, because a tax group is more than two entities but one taxable person. So any transactions between those two taxable two entities within the same tax group is actually eliminated, and therefore it is not considered under the participation exemption. Also, as per the law, if you see, any loss on the liquidation of proceeds is also not covered under the participation exemption. Any income which is not in the capacity of an owner, any income which is not in the capacity of owner, let's say if I was having an interest, A was having an interest in B, but B was paying, let's say, for any other operational transaction, let's say for any services, then this because this is not in the capacity of a owner, this is in the capacity of service provider and service recipient. This is an operational transaction, and therefore it is also not covered in the participation exemption. Now, if an entity is into trading of shares and securities, obviously the 12 months criteria will not be fulfilled. And if that condition is not be fulfilled, then this participation exemption condition is also said not to be fulfilled, and any income from the participating interest will be taxable and deductible for the corporate tax purposes. Now, if we talk about the practical application of this, we saw that there was 5% and there was a 4 million, at least a 4 million of investment in another entity, or 5%. So how is this 4 million calculated? Because we discussed that any expenses relating to the acquisition of the other shares, other entities shares, is actually capitalized for corporate tax, for the corporate tax purposes. So that you will add any additional investment also you will add, and you will reduce the buyback capital or capital reduction or any other repayment which has been done by company B to company A. Once you do that, you will get a total, and then from that total you remove the cost which is attributable to the shares which you have sold. Let's say if you have sold in the middle of the year, you will take the weighted average basis, and then you will remove those weighted average cost of shares, and then you will also add any obviously if any expenses are there attributable to the sale, transfer or purchase, then it will be capitalized. So you'll add that, and the total amount which is the resultant figure will be the capitalized cost of shares as per taxable records. So this has to be more than 4 million, or the ownership interest has to be at least 5%. Both of these conditions, either of these conditions has to be satisfied for the first for the condition number 1 which we saw. Now, moving ahead, talking about the participation exemption, and as you all are aware, there is activity in the free zone called as holding of shares and other securities for investment purposes. So what is actually a difference between the participation exemption and what is difference between a QFZP having this holding of shares and securities as their main activity of business? So this participation exemption is this is applicable to all entities irrespective of the place of incorporation. That means either it is if it is in mainland or if it is in free zone, in both of these cases participation exemption is applicable. But in the second case, talking about the qualifying free zone persons, only free zone person will be able to elect for this kind of relief, which is QFZP relief, not the mainland entities. So participation exemption is obviously available for all the entities in the UAE, all the residents and non-resident person as per the UAE corporate tax law. For the participation exemption, the main activity need not be an investment purposes. This can be a side income of an entity. But on the second hand, if you see the QFZP and this activity, qualifying activity of a QFZP, the main activity should be to hold the shares and securities for investment purposes. The participation exemption, in the participation exemption, we saw that holding companies are actually having three additional conditions to be satisfied. Apart from that 9% condition rule, holding companies should satisfy those three conditions. But in terms of, if we talk about the qualifying activity of a QFZP, this condition, there's no such additional conditions for a QFZP. Now, for a participation exemption, let's say if any of these conditions are not satisfied, whatever conditions we have discussed, if these conditions are not satisfied, then any income from that such participating interest will only be taxable. But this is not in the case of a qualifying activity of a QFZP. If the conditions, if the QFZP conditions are not satisfied, then the if you're not satisfying the qualifying activity conditions or any of the condition which is given in the QFZP, then all those income, which is irrespective of whether it is from the qualifying activity or no, all that income will be taxable at 9% straight away. And this is going to be there for the next 4 years also. That means current year plus 4 years, total 5 years, that entity will have to pay tax at the rate of 9%. So participation exemption is very straightforward, saying only the investment from that entity will be taxable or exempt based on whether the condition is satisfied or no. But in case of QFZP, it talks about the complete income, not only the income from the participating interest. Audit of a financial statement, obviously participation exemption, we did not see any of such condition. So audit of financial statements are not mandatory for a participation for the participation exemption. But for a QFZP, getting the financial statements audited is a primary condition. So this is what difference between the participation exemption and holding of shares, I mean the qualifying activity of a QFZP. So by this, I'd like to conclude the participation exemption webinar, and happy to take any questions. You can drop your questions in the chat box so we can answer it.
Yeah. Thank you, Amit. It was no. So I was saying that there are certain questions that are already asked in the chat box, and before that, I would like to mention to you all that we, as I mentioned, we provide audit, accounting, value-added tax, corporate tax, transfer pricing, and company formation services. So if you have any requirement, you can reach out to us. We're based out in Dubai, in Padmeta, with a presence in India as well as in US. And we also provide transfer pricing services for not only for these three countries, but also for many other countries within Middle East, in Europe also. So you can reach out to us for any of the services that you require. And meanwhile, let me just put up the questions that we have and then quickly discuss on them. In the chat box, we have some questions like, I see one question coming from Nusrat Abbas. If cost is incurred for subsidiary but not charged to them, is it deductible? So I think for this, since it is a related party and it is only deductible or allowed to be deducted as long as it is at arm's length, whether you charge it to them or not. I think that arm's length criteria is still required to be complied with. That's when you'll be allowed to be deducted as expenditure. I tried to reply to each individual questions directly, but for the benefit of others, I would like to just look into those questions and answer them.
Please check your message that I forwarded.
Yeah, I'm just going through others also. Most of the small and medium-sized businesses in UAE pays a lot of commission in cash and without any vouchers. Will it be allowed as expense? We understand that this is the expenditure that we are incurring for the purpose of business, but at the same time, are we in a position to demonstrate that it is the expenditure that we incurred wholly and exclusively for the business purpose or not? If you don't have any supporting document, it becomes challenging or difficult to demonstrate or prove that. So in that context, I don't think that you can show this as a deductible expenditure when you don't have supporting document. Not only this, any expenditure that you pay without having any supporting document or a proper supporting document, then that expenditure you cannot claim it as a deductible. So answer to this is no in general. And Has FTA issued any format in which the CT return is to be filed? So far, they have not publicly announced or released any format for CT return, corporate tax returns. But however, the returns are available on the Mara tax portal when someone is trying to go for deregistration and then submit return. So once you apply for deregistration, when it is approved, then you are asked to file this CT return for whichever period your company is in existence. So that's when the CT return form is available, but not in general. Can any expenditure be deductible if the company pays the amount to staff through cash without any supporting documents other than salary? I think this is similar to what we have in commission case. Any expenditure that you pay without having a supporting document, a proper supporting document, it will not be allowed as deductible expenditure for corporate tax purpose, because the basic reason is that you will not be in a position to demonstrate whether that expenditure is incurred for or wholly and exclusively for business or not. So in that sense, it will not be allowed as a deductible expenditure. Another question was from Meenu Agarwal. In case of connected persons, even if it satisfies arm's length principles pricing as per UAE guidelines, will it be allowed only 50%? I think the answer to this is that if that expenditure which you pay to these connected persons is in the nature of entertainment expenditure, of course, it will be allowed only a 50% amount of it. Plus, you need to make sure that the payment is at arm's length as well. So first thing is to make sure that it is at arm's length, and then out of that arm's length amount, only 50% will be allowed as a deductible expenditure if it is in the nature of entertainment expenses. See, the reason for this particular provision is that most of the times the entertainment expenses like hotel bills, transportation, accommodation, and travel, these are spent for the purpose of businesses, even if you're spending for customers, suppliers, or shareholders to a great extent. But at the same time, there's a possibility that these expenses could be incurred for the purpose of personal benefit. And some people may claim that as business expenditure. So by considering that loophole, the FTA or Ministry of Finance came up with this particular deduction of 50% only as allowed and remaining 50% not allowed. Any format specified to adjust transfer pricing gains or losses? Abid, do you want to address this? Abid is our expert who works primarily on transfer pricing. Yeah, Abid, do you want to take this up? Any format specified to adjust transfer pricing gains or losses?
Yes, sir. It actually is specific on the situation, what situation it is based on, because there are so many group companies who do it internally or based on internal or external. The format can be prepared.
Yeah.
That is something very specific to the case-to-case basis.
Yeah, and one more thing is I think there is a disclosure form also, which is generally expected to be filed along with the CT return.
Correct.
I don't know if that needs to be discussed or looked at on this particular point or not. But yeah, so when you have a transaction with related party along with CT returns, you're expected to submit a disclosure form also. That form is not out yet, but yeah, details are expected to be filed along with the return. For calculation of EBITDA, even carry forward losses, tax losses, is required to be adjusted to arrive to EBITDA, or should it not be considered? I think even carry forward losses also will be adjusted and the balance will be considered. These details are provided in the guide note that is released recently. Yes, I think it is. If the interest expense, next question is, if the interest expense for the current period is carried forward to the next year, will that amount also be considered in the limitation of 30% EBITDA along with the next year's interest expense? I think the answer to this is yes. You will be looking at current year expenditure as well as carried forward interest expenditure also. Altogether will be looked at for 30% EBITDA limit. Provision for gratuity or bad debts allowable. Are these expenses allowed to be deducted? I think on this also they have given a lot of information in the guide. Yes, they clearly mentioned that any gratuity or bad debts that you provide, as long as they are in line with the IFRS requirements, so they are allowed to be deducted as expenses for corporate tax purpose also. For gratuity in particular, you need to make sure that you are having the actuarial valuation also, if you have a good number of employees, because that is what is the proper basis for you to provide the expenditure for gratuity. And we do provide services related to that particular actual valuation for gratuity purpose. But it is going to be relevant and important to have proper basis for whatever provision you make, not only for gratuity or bad debts, for any other provisions or accruals that you make, you need to have a proper basis, and they are allowed to be deducted as long as they are in line with IFRS requirements. Another question was like and regarding the free zone exemption, 0%, how we need to select at the time of registration, or there any other application that need to apply to FTA? Avit, do you want to take this up? The question is like regarding the free zone exemption, 0%, how we need to select at the time of registration, or there any other application that need to apply to FTA? You're on mute.
I was on mute. Yeah, there is no such application that this free zone persons are actually assumed to be a QFZP. So if any of the conditions to be a QFZP is not satisfied, then in that case the election has to be done under Article 19 of the city law.
Yeah. We have certain other videos on the free zones related corporate tax rules also. And we also keep conducting more sessions on the various topics of reasons. You can attend one of our videos on this free zone, or in future we conduct, then you can also attend that to know more about free zone related rules, corporate tax purpose. I think there was one more question. If the free zone company, free zone entity or establishment company has only one person, which is the owner, and all the jobs are done by LLC company staff, is FZE meet the criteria adequate employees to be part of the qualifying free zone entity? So this is a clear-cut advisory question. So you have an entity in free zone, and only one owner is there for that particular free zone, but the works are being done by the mainland entity, and the staff is in mainland, and the work is done by the mainland entity. So in that case, whether the free zone entity will still be considered as a qualifying free zone entity or not. Abid, again, do you want to take this up?
Yes, sure, sir. So basically, if the work is done by a mainland entity, then you have to see whether it is a routine activity or no. If it is a routine activity, then it is fine. But any core income generating activity has only to be outsourced to a free zone entity within UAE. And we have some more deep into that also. Let's say for about R&D activities in terms of qualifying intellectual properties, that you can only outsource to another entity within UAE, let it be free zone or no, but you can also outsource to any entity outside UAE, but it should not be a related party. So that is something which we have to consider. It cannot be outsourced to any entity which is outside the free zone.
Yeah. And another thing is that this may be considered as a domestic permanent establishment. So those rules may also be looked at. So as I mentioned, the solutions or answers that we're giving are not the final answers. These are only based on the facts that you have given here. And out of what we remember is what we are telling you. We strongly recommend you to look at the law before you take any decision or conclusion on this. These are only some inputs that we are giving so that you will be able to understand a little bit more, and then refer to the law and then take the decision. So what are the action points to be considered during 2024 if we have such assets in our balance sheet like intangible assets booked at historical cost and we have no plans to sell in 2024? I think here I just wanted to give a clarity that it's not only in 2024, you can sell it in any future periods. The same rules are applicable. The gains relating to your city regime will be subject to tax, and gains before that is something that you can claim as exemption as long as you go for that election in your first tax return. Election to go for this realization basis is the crucial thing in your first tax return. So if you forget to do that, then you will not be eligible to claim this benefit again in future periods. So the election needs to be done in year 1 or your first tax return. And you can get this benefit anytime whenever you sell this property or immovable property or intangible assets or any other financial assets and liabilities. Yeah, so the benefit will be given whenever you sell, not only in 2024. So I think one more question is like input tax paid on dependent's medical share is not recoverable as per VAT law. The same can be deductible expenses in CT law. I think it's most of the companies will have this particular issue. If you are providing the insurance, medical insurance to the dependents of the employees, the VAT paid on that particular premium, insurance premium, is generally not recoverable. Okay, so then that becomes your expenditure in your books of accounts, whatever your tax or VAT amount that you paid on that particular premium. So will this be allowed as expenditure for corporate tax purpose also or not? I think the answer to this is yes. If you have paid some VAT and which is not allowed as a recoverable tax under VAT law, that can be shown as deductible expenses for corporate tax law. But if you have eligibility to recover that particular tax or VAT amount that you paid, but you have not shown it as input tax credit, then that is not allowed. Because you are eligible to take input tax credit, but you are not taken. Then because you are not taken, you cannot claim that or show that as expenditure for corporate tax purpose. So that is clearly mentioned. If I'm an employee of my UAE company and choose salary or wages instead of dividends, will these wages be deducted through my regular profit or loss calculation before corporate tax? Abid, do you want to take this up?
Yes, sir. So this salary and wages, yes, if you take instead of dividends, the salary and wages, this is considered as a deductible expenditure as per city law. But you have to make sure that you will be considered as a connected person in this case. Then if you're considered as a connected person, then again that rule applies that it has to be for a business purpose and it should be at the market value only. If it is not at market value, or if it is not for a business purpose that you are taking the salary or wages, then it is not allowed as deduction.
Yeah,
And
so
in
not
this,
only that, I think the documentation also you just need to look at.
yes,
If you're only owner or shareholder and then you're not a manager, so in what capacity are you providing the services also will be questioned. Neither you're an employee nor a manager on the license. This will also be, I think, questioned. So just it as a administration thing that you need to look at, and then you become a manager also on the license, and then you provide services. More another thing to look at it is that you may also mention the salary amount that you or remuneration amount that you want to take, that legal document also. Plus, as Avid mentioned, you have to make sure that that is at market value. So we need to perform, in addition to other profiling and other things, we also need to perform benchmarking, and then other documentation need to be in place to demonstrate that the amount is at market value. Is there any maximum interest rate specified by director's loan? Avid, for you again.
this depends on case to case basis. It depends on the terms and conditions of the loan. So I would say the benchmarking process has to be carried out here to actually understand what is the range. You will not get the maximum, but you will get a range that is okay from the first quartile to a third quartile. It is a range of interest rate which you can pay or charge to the related party, including a director's loan. So it depends on the terms and conditions of the loan, the currency, the term of the loan, and all those things.
Yeah. So one more question is, for how many years can the unadjusted losses be carried forward? For losses, there is no particular limit as such. You can carry forward to a number of years. But the only thing is, as I mentioned in my presentation, is that you need to make sure that from the year when you make the losses till the year when you want to adjust or offset the losses, you need to make sure that the ownership is same, at least to an extent of 50%. Or the business activity of the company is more or less same in all these years or in these years. If both these are not there, then you cannot claim or offset the losses. like the ownership is not same to the extent of 50% in these both the years, and the activity is not significantly same in both the years. If these two things are not being met, then definitely you cannot offset the losses against the profit of that particular year in future. The shareholder waive its receivables or claim from his company. Is it generally taxable? I did not understand the question. I don't know if you have understood.
So I think it want to ask that a shareholder has a receivable from an entity, then that receivable, if it wants to waive off, then it is actually an income from the company perspective, because it need not pay. So this is considered as a taxable income. Yes, this will be included because it is as per IFRS. You'll have to book it as an income in your books of accounts, and it will be included in your taxable income. So the answer is yes, it will be generally taxable.
Yeah. Or salaries deductible expenses, generally yes. Any payment that you make, not only salaries, but any other payment that you make as part of an employment agreement with your employees is generally allowed as deduction, which also includes, needless to say, bonuses or any other payment that you make or consideration that you give in kind, not in cash, is also allowed as expenses. The only thing is that if these employees are connected person, okay, that's when the issue comes in, as we mentioned in the previous discussion. As long as those payments that are made to the connected persons, though they are employees, if they are at market value, then it is allowed to be deducted. So payments made to the employees, this has been discussed at length in the guidance note that was released in like a couple of days ago, and they've also given certain examples. So the entertainment expenses that are paid or given for the employees, that also is allowed to be deducted. Not only that, if you are like conducting any event or any social gathering in which you have employees as well as you invited the spouse of the employee, is also considered as deductible expenses, unless otherwise it is not no in general practice that you do. So which means any payment that you make or benefit that you offer to the employees as part of your employment agreement is generally allowed as deduction or deductible expenditure. And one more question that we have is that we have invoice to KSA client amounting to 20,000 dirhams, but when they make the payment to, they remove withholding tax of 2.8 thousand. How shall we treat this 2.8, since in our invoice we have $20,000, but whereas we have received the net amount of $17,200. I think the withholding tax that you paid to outside UAE, that income is included in your taxable income in UAE, is also eligible to claim for foreign tax credit. But the computation of the amount that you are eligible for tax credit is not the same amount, but you have to compute the effective tax amount, and then that is what is eligible for claim. So I think one last question that we have is that if the company is under liquidation or planning to liquidate this year, is it still necessary for corporate tax registration? I've not seen any clear guidance on this particular incident or scenario. But as far as what we understand is that once the company has the CT regime applicable to them, so the company, like most of the companies, January to December is their financial year, which means from 1st January 2024 onwards, for most of the companies, the corporate tax is applicable. So once the corporate tax is applicable for your company, during the year, if you're going for liquidation, you are expected to register for corporate tax purpose and then apply it for deregistration. And for whichever period you are your license is active in this particular year, so you are expected to submit your corporate tax return within 3 months or 2 months timeline that they mentioned from the date of liquidation. So yes, you are expected to register, deregister, and then file the corporate tax return, even if you're going for liquidation or planning to go for liquidation, if corporate tax is applicable for you already, corporate tax rules. Okay, so these are the questions that were asked. Thank you all once again for attending and taking out time for attending this session. And one or two points I wanted to address is that in the guidance note that they have released, they have given a non-arm's length expenses. Any expenditure that you incur if they are not at arm's length, if you make any payment to related parties or connected persons, then the amount that is in excess of the arm's length or market value will not be allowed as deductible expenditure. Only the amount which is at arm's length is what is allowed as expenditure to be deducted. And expenses that you incur for incorporating the company, any pre-incorporate expenses or trade expenses, are they allowed to be deducted for corporate tax purpose also is one area which they have clearly mentioned. So expenses that you incur for incorporation of the company or pre-incorporation, whatever you do, you may do markets research, or you may do some survey, you may do some, you may take some consultation or something. So all these expenses that you incur to incorporate business, what you incur before the incorporation of the company, as long as they are connected to this particular business incorporation, and you have a proper supporting document to prove, then they said that it is allowed to be deducted as expense. Some companies, they incur some expenses before they start their business. They establish the company, but the business is not started yet, or the operations have not been started yet. But you incur some expenses in connection to that particular business running, or to develop a product, or to do something. So all those expenses also, can you claim those as expenses or deductible expenses for corporate tax purpose? They mentioned clearly in the guide, yes, you can claim them as expenses for corporate tax purpose also. Okay, so there are the few points that I thought are interesting from the point of view of corporate tax out of the guidance that was released. So yeah, you can see our other discussion that we did on YouTube links that Raghu is sharing in the chat box. So thank you again for attending this, and we request you to reach out to us on our contact details whenever you have any requirement of corporate tax, transfer pricing, audit, value-added tax, accounting, or company formations, or PRO services. So we are happy to provide those services, and thank you all once again for attending this session. And we will share the link of the YouTube video as well as the presentation for your reference if you want. And thank you, Abid, for your contribution. And
Thank you, sir. Thank you.